I've made a lot of money and I've lost a lot of money in the DeFi industry. Now, I've also had experience from being a person that invest into Ponzi schemes in my early days, moved to yield farming where I was just chasing the highest returns and yields, moved to Uniswap liquidity pools through V3 and concentrated liquidity, moved to full range, stuff like that, right? And then also eventually worked for some hedge funds, did some consulting at one point in time to launching my companies, where one of them we've worked with over 300 plus clients. We've helped deploy over $50 million in DeFi. Our largest investor had $50 million in crypto. And again, that's all done through coaching, implementation, whatnot, hands-on stuff. And then also my software company, where we have the data from 30,000 plus lifetime users or so. So we know exactly what's working and what's not working, right? So I want to just condense all of that in this video. Now, fair warning, this is going to be a long video. We have 55 different points to go through. And I do want to be fully transparent. We have our own AI tools. So we've basically built like AI Jake or so for our clients to use or so, which is trained on all of my content, all of our internal stuff that the public has never even seen, even like calls with my team where we're discussing strategy, one-on-one calls with clients, right? It's trained on everything. So we've been able to utilize AI to condense all of this. And yes, there's a lot of stuff that is missed here into one document. So let's go over it. And again, if at any given point in time you are finding value in this video, all I ask is 3 different things. Number 1, drop a like. Number 2, subscribe when notifications turned on so you don't miss out on more great content like this. And number 3, comment down below what issues you're currently facing in DeFi, and I will do my best to try to solve them on this channel through my content. So first things first, we're gonna go ahead and blow this up and go over number 1, which is focus on fee consistency over APR hype. The last thing you want to do is chase APRs. A lot of people have the mindset like, oh, this thing's doing, if we just sort by APR, 2,656% APR. This one's doing 2,500%, right? And they think that they are just too smart or something for the game, right? They think they're a genius. They're like, well, in this case, if I throw $1,000, $10,000, $100,000 in here, right, then ultimately, I'll generate enough yield that it will outpace any asset loss. No, it never ends up that way. It really never does. And the reason why is because these APRs fluctuate. When you're typically dealing with these high APR pools, they're low TVL and they have inconsistent volume and fees, meaning that ultimately you will not get that. And of course, this APR is obviously based on your actual current capital in the pool. So if you invest 1,000 and all of a sudden the asset just flicks 20% or so, which a lot of times is what happens with these meme coins or random tokens that just pop up, then ultimately you are left holding a bunch of an asset that you don't want and you're out of range and not earning anything. That's why you have to position yourself properly. Now, on top of that, the other condition is looking for just super high APR pools with maybe good assets, but assets that don't make sense to be in a pool. So something that, let's just say, for example, I thought K-pop was an amazing token, right? But it could go up like 10, 20x over the next week or something because it's such a small market cap. And by the way, I have no idea what K-pop token is. Well, if it could go up that much, I'm not going to want to allocate a huge portion here because ultimately the risk to reward is off. The risk adjusted return is not good because I can miss out on all those gains because I'm just stuck earning a couple bucks a day in a liquidity pool, right? So that's lesson number 1. Lesson number 2 is choose pools with high and steady volume to TVL and fee to TVL ratios. So what are these, right? These are essentially the metrics that determine overall health of a pool. So when we look over at Metrics Finance, you have this daily fee to TVL, daily volume to TVL, right? This measures how much fees you have compared to TVL or how much volume you have to TVL. It shows you basically what pools are active and what pools are not active. Now, there's no set number here because this is adjusted on a daily basis. We have 362 pools. My philosophy here, I guess you could say, or plan, strategy, whatever. I don't know. It's 12 a.m. I'm tired. I like to kind of go through, filter everything down like I would usually do, and then go to daily fees to TVL, sort by highest first, go to the absolute middle of the list. So let's just do 100 pages, and we have 362, right? Go over here to the middle page. So that would be roughly towards the end of page 2. So let's just say this one, 0.042%. And I like to look at higher than 0.042%, right? Because we're using actual data based on today, right now, as opposed to a set number. Now, some of these other things you can use set numbers for. Like I still like to look at TVL higher than $1 million. Maybe in a couple years, I'll be looking at TVL higher than 5 million. Who knows? But that's one thing. Simulate ranges and impermanent loss versus fees to confirm real profitability. This is validating the pool, making sure that it actually makes sense to be in the pool. We always do this, and you could do this on metrics. Compare the same pair across fee tiers, DEXs, and networks. Again, we have one-click access to do this on metrics. But basically, there are probably hundreds of ETH to USDC pools, maybe thousands. How do you know you're in the best one? You're taking the same amount of risk, but you could get a better return elsewhere. Find that better return. Use recent data windows to avoid skewed results. So when you are calculating APRs, a lot of tools will only show you 24-hour. Why? Because 24 hours recent data. Some will show you 30 days or allow you to use 30 days, like metrics lets you use 30 days. But again, we might be using, say, 30 days or so here, but then we have volume inconsistencies to the point where it doesn't make sense to look at 30 days. It makes sense to look at recent data. So we look at recent data. Favor wide or moderately wide ranges to reduce churn. So again, this reduces you having to constantly rebalance and churn out your fees to impermanent loss. And of course, gas fees and everything like that. Wider ranges typically win. This is after analyzing data from hundreds of thousands of positions, basically. Wider ranges typically win, where you not set it and forget it, but maybe you're in range for a couple weeks or so. Use price alerts over automations, or just alerts in general over automations, because alerts allow you to say, hey, I need to go on my computer and do this right now. And then you go on your computer, you start look at things, and then ultimately you say, okay, well, actually, this was just a wick. Whereas the automation, if it saw that wick, it would have rebalanced, and it would have bled fees right there to impermanent loss. So keep that in mind. I will say, if you are an emotional investor, which you need to learn how not to be if you're in the DeFi space, which is just going to come with paying the ignorance tax and losing money, then automations can be your friend, because automations sometimes hold you accountable. Same thing with take profits and stop losses on exchanges. If you just let it do it for you automatically, then you don't have to worry about, be like, oh, what about a little bit more profit? Rebalance only when risk or thesis changes justify it. So again, whether that's kind of close to going out of range, whether that's ultimately on an overall portfolio level, always base it on an actual decision, not just be like, oh, I'm rebalancing for this. There needs to be a reason to rebalance. And hot markets prioritize crypto to stable or stable pools. Now, the reason why here is because with crypto to stable pools, we can sell as the market is going up. We can use crypto to stable pools to take profits into stuff like stuff like USDC, and then buy back in at lower prices. In oversold markets, use crypto to crypto pools so that way you can capture full upside. So if you're bullish, use crypto to crypto. If you're expecting a potential dip or retracement, use crypto to stable. Track your true profit loss with manual entry overrides, right? So on Metrics Finance, you can go over to the track page. You can see your overall profit loss. You can view all that data for the supported exchanges. You can even add custom positions that we don't track, so you can see everything in one place. Now, one of the cool things we have is the ability to override the data, and we do that across the entire app. So you can use calculation timeframes. You can use different calculation methods. You can truly make sure you're getting a good calculation, but also when you're actually tracking performance, once this loads up, which again, we're improving our data systems. We have too many users basically. So that's why they're somewhat slow. Updates coming soon, but you can dive into these positions. You go to the history of the actual position itself right down here. You can change the prices. So that way you can input your true cost basis here as opposed to just the one that the value at the time of this transaction, which unfortunately is all we can actually pull, the value at time of transaction. This was $64.79. Maybe you purchased it for $64.85, right? So that's $6 or so. That helps you track your actual cost basis. And then on top of that, benchmark every position against alternatives. Always look at positions compared to other positions to truly make sure that that one is the best fit for your portfolio. Aggregate performance by strategy to scale what works. So again, you have strategies, you have positions. Ultimately, ETH to USDC could be a strategy, or lending out ETH, borrowing USDC, taking that USDC and putting it in ETH to USDC can be a strategy as well. You have to view it as a strategy, not individual positions, because these are all part of a flywheel, and these are all moving components within a strategy or portfolio, and we want to make sure that they are working together. hedge large liquidity pools with small shorts or options. Now, this one I would typically do whenever the markets are starting to kind of become a little bit bearish or maybe just going sideways. I'll throw in some options if I'm expecting volatility in a relatively quick window, or I'll throw on some shorts just to hedge my downside. And we also have tools that we're building to automate this, because when you are running a strategy like that, automations can become handy here. Size your borrow-based strategies conservatively. A lot of people like to borrow 50, 60% loan to value. Horrible idea. Case study as to why not to do that is when we saw the liquidation day in DeFi, where the market completely crashes, the largest liquidation day like ever. So, and that was back previously in October. From October 7th, Ethereum went from 4,700 all the way down to a bottom price of 3,600 or so. So again, if you're borrowing at 50, 60%, you probably got liquidated on that day, especially if it wicked down. A wick can liquidate you. Keep that in mind. Even if it doesn't stay down there for longer than 30 seconds or so. Know your liquidation levels at all times. So that way you are informed. You can make proper decisions. You know before you get liquidated. And set alerts. Build around a diversified, unlevered liquidity pool core. Again, I like to have a liquidity pool core, like I talk about in my previous videos, where I have, in this instance, talk about this in the last video, 40% of liquidity pools. This right here is the main income driver in my portfolio. It's a huge chunk of my portfolio, don't get me wrong, but it's across a couple different liquidity pools, which is another lesson I'll probably go over as well. You don't need a ton of diversification. Diversify more where it's more hands-off, but still don't be over-diversified. Liquidity pools, I like to run 3 or 4, sometimes 5 at once. You don't need 10. If you're going to diversify that much, you want exposure to other assets, just throw them in HODLs, throw them in lending, stuff like that. Add selective hedges instead of tight leverage. So again, don't leverage yourself too much. Don't go and, on a liquidity pool in this example, select such a tight range to the point where you're instantly going to get wicked out. Rather, go and open a broader range position and add potential hedges with automations or limit orders or something like that at bottom and top prices. Implementation matters more than information. This is a pretty simple one. The more you do, the more you're going to learn. You can watch all my videos. You can watch all of everybody else's videos, right? But there's a lot of noise out there. And the more you do, the more you're going to learn. Now, here's what I'd recommend. Watch the videos, take in the information, because that is going to give you an advantage, right? Maybe you work with a coach if you have the ability to do so, whether it's my team or whether it's another team, right? But ultimately, make sure you're working with the right coach, and that coach is going to be able to help you avoid those mistakes because they're going to be your partner in that, assuming you go with actually good coach. But then from there, you still need to scale in. You need to start small and continue to ramp up your capital. So that way, when you do make mistakes, you'll make fewer, but you'll make them with smaller amounts of capital. And then you've made it, you know not to make it again, and ultimately you can start to scale up your capital. Follow a loop. Discover positions, simulate positions, make sure that they're actually good. Deploy your positions, monitor them, and then optimize them. Design your portfolio before building positions. That's exactly what we did over here. How much do we want to have where? What are our targets, right? We actually built out entire software just for doing this. It's called Portfolio Vision AI. But this software is exclusive to our clients because it follows our roadmaps to a T, basically. And if you don't have a roadmap, it's not really worth going through the software. But yeah, portfolio modeling is a big thing. Size risk by allocation, not intuition. So again, you need to always allocate to the best risk-adjusted return, not the best return, because the best return is probably the highest risk. The best risk-adjusted return. For example, if ETH to USDC, or let's not use ETH to USDC, let's say wrap Bitcoin to ETH is our lowest risk position, but it's doing a return of 20% and maybe has a risk level of 1, so our risk-adjusted return is 20%. But then we have Sol Render, which is doing 60%, right? And it has a risk level of 2. Well, then the risk-adjusted return right there might be 30%. So ultimately, we would allocate more to Sol Render, even though it's a higher risk position, has a better risk-adjusted return. Treat divergence loss as the main LP hazard. Again, this is a big one, but if you know how to use it right, you can use this to your advantage when you incur it, basically. I like to think of divergence loss. I think it is David Zimmerman. Big shout out to David Zimmerman. I think it's David Zimmerman that said this. He likes to think of divergence loss as a feature as opposed to a risk, or as opposed to something that's bad against your portfolio, which I think is a great quote because you can use it as a feature and you can use it as an opportunity to your advantage as opposed to it being a burden on your portfolio. Diversify and plan for worst case scenarios first. Always, always, always back test worst case scenarios to see what's going to happen. Make sure you can stomach it. Make sure you can look at that number and be like, yep, this is where I'm at right now, right? I think I lost 80 grand in a week. Again, I didn't lock in losses, so I didn't actually lose it. But when we saw that liquidation day in October, down 80 grand. My parents asked me, hey, how's your crypto portfolio doing with all this? I'm like, oh, yeah, I'm down 80 grand. They're like, what? They're like, that's more than I have in crypto. And you're down that in a week. But again, I could stomach it, and I could look at it, and I could be like, this, yeah, I mean, might affect my financial future, but it's not going to put me on the street. It's not going to affect my lifestyle because I have not adapted my lifestyle based on my crypto portfolio. Something you should never do. Right? Until you're taking those profits, basically, and put them in your bank account. Use Fate, which is our framework for essentially finding pools. Use a framework for finding pools efficiently, whether that's filtering and whatnot, whether that's using DeFi, Llama, Metrics Finance, something like that. Use Valid to verify pool quality and fit. This is validating pools. Always, always, always validate pools to make sure that they are actually a good investment for investing into them. And again, I'm going to do a brief interjection right here. If you guys want me to make detailed videos about any of these points, feel free to let me know down below in the comments because I am happy to do so. I have a lot of free time right now, and I'm happy to essentially just make some content around this. Back into it. Ensure volume and APR are sustainable. Always make sure that when you dive in, if you're looking at something that's doing 100% APR, make sure it's going to sustain 100% APR before diving fully into it, expecting to get 100% APR for like a month, 2 months, and then getting it for a day or 2 days. Always ensure it's sustainable. Avoid shallow yield stealing pools. So what does this mean, right? This is essentially pools that have a super heavy concentration within liquidity. Typically, you're going to find these over on Aerodrome. So if we look very briefly at Metrics Finance over here to something like CBBTC to ETH, and we look at liquidity distribution, you could see there is $10 million on this one tick, and then it goes to 1.2 million or 983K. So when we're looking at this, right, it's like, oh, 230% or, oh, 214%. Well, no, because this liquidity is either going to move, which it typically does, or this price is going to revert back to where the bulk of the liquidity is, where we're actually doing 24%, 90% less, right? So avoid that. Or don't avoid the pools entirely, just avoid kind of looking at those metrics of like 200% and expecting to actually get that. You got to look around that liquidity distribution. Confirm the correlation and volatility alignment. So one thing I learned actually, big shout out to Richard over on Twitter and YouTube. He has a great channel. He's like a quant basically, great guy, good with math. Had a few conversations with him, and he made a post that actually stood out and kind of like suspected this a while ago. Correlation measures asset movement together, right? But assets can essentially move together, but go up different percentages. Keep that in mind. Volatility, or at least price volatility of a specific pool, like this price volatility number right here, measures the volatility of how many ETH are in one CBBTC. Low price volatility actually means lower divergence loss. Direct correlation there. Whereas the actual correlation coefficient over here, which is 0.89, there's an indirect correlation with that and lower divergence loss. So do keep that in mind as well. Track your earnings retention. How much of your earnings are actually keeping and actually going into your wallet? You might have $1,000 in earnings, but you would have had $1,500 more if you just held in the market. So track earnings retention, profit versus HODL, and total profit. Important metrics right there. Log your cost basis, edits, and hedges accurately. Always make sure you're tracking this, especially with hedges. Sell income, don't auto compound by default. So when it comes to selling income, I like to use income as a means to take profit from my portfolio, at least one of the ways. Meaning that if I park my money in, say, Sol Render or something like that, and I want to take profits from Sol Render, I'll park it in Sol Render liquidity pool. And ultimately, this income I can take as a profit and sell it without actually selling my underlying bag. Or I could use crypto stable positions to take profits as well. So you could sell income, or you could sell it to other aspects of your portfolio. So whether it's lending to borrowing, whether it is repaying some of your borrows, increasing collateral, whether it's putting in a different strategy, whether it's putting into higher risk strategies, stuff like that. Don't just, income from Sol Render, put back in Sol Render. Don't do that. That's like the worst way to compound. Be strategic. Be smart with your compounding. Route fees to stables to lock in profits. Again, that kind of goes down to what I was saying. Sell your income to stables, lock in profits. And again, you'll probably eventually use those profits to buy back in at lower prices. Reinvest only into top performing strategies. I like to allocate to liquidity pools in this instance, maybe 50 grand. And then I have another 20 grand to bring in. I reinvest into the top performing positions. I don't just evenly distribute. Maintain allocation caps for risk control. So liquidity pools, typically, I don't like to have more than 30% of my overall liquidity pool allocation in one single strategy. So it gets tricky when I'm running 3 strategies because one of them has to break that rule, basically. But when I'm running 4, typically I'm fine. I could be right at that 30% cap on at one of them or something like that. Start with safer yield while learning. Guys, it's way easier to learn with something like ETH USDC, ETH wrap Bitcoin, right? Those types of pools than it is to learn with altcoins paired with ETH. Also, if you're completely green, new to DeFi, it's easier to learn with just interacting with platforms, swapping, trading, staking, lending, right? Just one-click stuff. And then once you get a hang of it, then start to go into this more complex stuff where we bring in rebalancing and all this stuff. Let auto compounding happen only in low risk assets. And this also includes low risk strategies. So stuff like staking, fine to let that auto compound. Something like a liquidity pool, not fine to let that auto compound because I like to route that income accordingly, as I mentioned, according to my flywheel technique. 38, rebalance near your entry price when possible. You will have $0 in divergence loss at your initial pool entry price. Not your initial dollar entry price, initial pool entry price. Take a look at this. I enter this pool at an average price of 77.5 roughly. When we go back to 77.5, I will have $0 in divergence loss. Regardless of what price Sol and Render are at, I could be down 5 grand, but at least I will have $0 of divergence loss at that price point. Or I could be up 10 grand and I will also have $0 of divergence loss at that price point. So the closer you can get to that, the better. So do keep that in mind, which is also, we'll actually dive into that in just a second. We essentially rebalance early if deterioration is obvious. So in the instance of, going out of range or something like that, we like to rebalance very, very quickly if it's very clear that the trend has changed and then it's going to take a while to get back down to where our entry price was. And then the follow-up to this is wait 42 to 72 hours during volatility before acting. Again, the exception to this one is rebalance early if deterioration is obvious. But again, waiting 48 to 72 hours, typically if you go out of range, a lot of times you have opportunities where you go back in range. Set price alerts so that way you can rebalance, or you can set automations in this instance, just one-off automations to rebalance as soon as you go back in range if you do want to rebalance, which there's some methods that you can use to minimize divergence loss when rebalancing as well. Use 80-20 asset ratio alerts for timing. So this is typically my rebalance indicators or start the clock indicators where I'll wait like 24 hours before executing a rebalance. If I start with like 70% of one asset, typically when I have 90% of that asset is when I'll set this alert. Or if I start with 60% of one asset or 50% of one asset, when I have 80% is when I'll set this alert to say, hey, I probably need to rebalance soon. And I'll set the alert. Once it goes off, I'll go and I'll set another one and I'll also start a timer on my phone. So that way I know to go and rebalance within like 24 hours or so. And then choose add capital or swap rebalance wisely. So a lot of people don't know this. If you don't swap anything when you rebalance, you don't lock in any divergence loss. So if you just add capital, you bring in more capital, whether it's ETH, USDC, whatever, then you aren't swapping. You're bringing in new capital. I mean, you're not locking in any impermanent loss, divergence loss, right? Also, I'm going to use both terms. I don't know why I use both terms. Some people understand one, other people understand the other. Exit crypto to stable, sell the rip ranges at full sell. So ultimately what this means, I know it's a lot of buzzwords in this one, is as the market is moving up, actually exit your crypto to stable positions. A lot of people want to use crypto to stable positions as take profits, right? Or sometimes even dollar cost averaging into the actual crypto. You need to actually exit them. Otherwise, market goes down, you accumulate a bunch of ETH, you don't exit, market goes back up, now you're back in USDC. Like, make sure to exit these positions. Recenter the buy the dip ranges quickly after full recovery. So again, whenever you buy the dip using crypto stables, make sure to recenter those and ideally flip them into crypto to crypto pools as well. Funnel your high risk income into safer yield. And additionally, I like to add to this and funnel my safer yield sometimes into higher risk income. But yeah, I always like to lower my risk over time, especially as I increase my overall portfolio value. I become more conservative, which I think is relatively normal. Convert your earned Ethereum or income into target alts. So what this is essentially saying is, we're going to use this instance of Sol just because I have this one pulled up. When I essentially am in this Sol to render liquidity pool, I'm earning both Sol and render. Typically, this is around a 50-50 split. Well, the Sol, if I want to accumulate render, I'm selling all this Sol to render. That is, of course, if that's my accumulation strategy. Sometimes this Sol will go over somewhere else. Sometimes both of these assets will be sold into something else or another aspect of the portfolio. But if I want to just compound and accumulate render, I'm selling all this Sol into render, basically. Again, one of the many strategies you could do. Gradually lower portfolio risk through rotation. Again, rotating into lower risk strategies, lower risk strategy types like liquidity pools, lending, staking, hodl, stuff like that. Low risk positions. Do that over time as your portfolio grows. Replace losers with correlated higher income assets. You don't have to make the money back from the position that you lost the money from. It's saying, hey, you know, this strategy is losing me money, so I'm going to double down on it. Like, you don't want to do that. Hedge your liquidity pool exposure with perps when needed, of course. That's a big one. Track hedge legs for full portfolio transparency. You can do that on metrics. You can go over here, add your hedges, basically, just like this. And I'm also going to do another intermission right here. The beauty of metrics is I've literally built it. And when I say I mean like I've designed it with my team, and my team has built it. I have an awesome team, and I want to give big props to them. We have a full-time development team, costs a lot of money to run. Luckily, we have a lot of users, and we're the largest liquidity pool software on the market right now. But we've built it and designed it based on all of these principles. So if these principles resonate with you, perhaps check out Metrics Finance if you haven't already done so. We have plans ranging anywhere from free all the way up to $100 per month. And our highest plan, which is $100 per month, if you pay upfront for a year, you get it for $800. And a lot of times you're going to see that $800 return by just making better decisions and using our tools, saving time, stuff like that. We have some ROI mechanisms to make sure that you're getting a return on that actual $800 because it is an investment at the end of the day. Prefer manual execution for lower cost and control. I don't like using zapping and stuff like that. And the reason why is because you pay fees to zap. Just learn how to do it yourself. You'll be able to do it in 3 minutes. Why pay the fee for zapping? At $100,000, if you're paying 50 basis points, it's a lot of money that you're paying right there just to zap. Just do it yourself. And there is something that I want to mention to that. If you're a beginner, zapping is also a good tool to use just to get familiar with things. So do keep that in mind. But yeah, I mean, if you want to become an advanced user, I wouldn't recommend zapping. And that's coming from the person that is going to implement zapping on Metrics Finance. Like, I'm saying that because I truly want you guys to have the best results. When we implement zapping on Metrics Finance, I'm not going to use it. I mean, theoretically, I could because the money goes back into my pocket. Some goes to my team, yeah, but it does go back into my pocket. But it's my principle at the end of the day. I like to use manual work as opposed to automations because you save money when you don't have to use those automations. And it's great for beginners, and that's mainly why we're building it. For beginners that want to get into this, use our tool. And again, we'll have some ROI mechanisms there. Execute trades during quiet market hours. So again, I don't like to do stuff on weekends because typically those are too quiet, but I don't like to do things during volatility either. And typically I'll do things at night, like for example, 6 p.m. to midnight, basically, Central Time, because that's where there's lower volatility. Typically the volatility is in the afternoon or even the morning. And then build a compounding flywheel between risk tiers. So again, that goes with different strategies, but also goes with your high risk versus medium risk versus low risk, compounding into those different mechanisms. Scale proven strategies, cut your underperformers fast. So this is pretty simple. Do more of what's working, basically. Essentially, whenever a strategy is doing good, and if you have one that's doing bad, don't let it continue to do bad. Don't wait for it, right? And I don't mean just cut it like within a day or 2 days. I mean like give it some time to perform. And when I say underperformers, I mean ones that are truly costing you to be in them, like low earnings retention, negative earnings retention, stuff like that. Or maybe APR is like way not what you expected. If you expected 100% APR, it's 80% APR, just give it some time, right? Especially if you have other good mechanisms. Again, there's ways to identify underperformers and actual proven strategies. But again, do more of what's working. And then lastly, but not least, always base your actions on data, not emotions. This is the most important thing, and that one speaks for itself. So guys, any questions for me, drop them down below in the comment section. Any video ideas, drop them down below. I'm happy to break down any of these. Hope you enjoyed. Drop a like, subscribe, notifications turned on, and I'll see you guys in the next one. Peace out.